Yeah, hello. Let's go on with our small lecture on the double taxation treaties. And today's chapter will be on how the methods for avoiding of double taxation are transposed or are laid down in the OECD Model Convention. Well, let's start with a small overview. You know that the general principle of the OECD Treaty is that the rules laid down in Articles 6 to 21 just state if the source state may levy a tax. So the OECD supposes that the state of residence always will have the idea to tax the worldwide income. By the way, that's secured by definition. Um, and so the articles with headlines like income from immovable property, enterprise, or business income, dividend income, interest income, they only lay down if the state where the money comes from, the state where you are not resident, can levy a tax or not. That the state of residence may tax in principle everything is taken for granted. But if the source state has a right to levy a tax, then it's the duty of the state of residence to avoid a double taxation. So they must reduce their claim for their own tax by applying one of the methods for the avoidance of double taxation. Now, you know, in principle, there are 4 methods, but the OECD regards only 2 methods as fitting. So, just to bring back to your memory the testing scheme for DTT cases. First, you begin with determination of the residence of the taxpayer. So you must first find out what is the residence country, because these roles must be clear. Who is residence country, who is source country? Otherwise, the whole formulas in the DTT go wrong and create confusion. Now, the next question is, may the source country take taxes? That is in Article 6 to 21, as mentioned just now. And then the last step for each transaction is, how must then the residence country avoid a double taxation if the source country is allowed to levy a tax? And this last step is what we are going to talk about now, because it makes sense to speak about that in the beginning. Okay, so for the OECD Model Convention, as I mentioned, there are only 2 methods for the avoidance of double taxation, which are regarded as sufficiently generous to really avoid double taxation. That is first the exemption method, and secondly the credit method. So you have only the choice between these 2. For this reason, because that is always the same, you either exempt or credit, the reaction of the state of residence is basically always the same, and that is the reason why this reaction has not been stated in each individual article 6, 7, 8, 9, 10, and so on, but has been outsourced and moved to a single article at the end, not the very end, but the relative end of the treaty. It's Article 23. There you always find the lines. If the state of source can levy a tax, then the state of residence will exempt, or the state of residence will grant the credit method. Now, unfortunately, there has never been a worldwide willingness to agree on which method for the avoidance of double taxation is really the best one. There are countries which prefer to apply the exemption method wherever this makes sense, it is possible, and so on. These countries only apply the credit method to some very peculiar kinds of income, mostly to dividends and interest, and all the rest will be exempted because they are great exemption fans. Now, there is another group of countries which is totally opposed to apply the exemption method. They want to apply the exemption method under no circumstances at all. The only thing what they are willing to do is to apply the credit method everywhere to everything always. So these 2 opposed groups of countries could never brought to an agreement. And now the OECD had the problem. They could propose a draft version for a model convention or for any convention which found the agreement of all states involved. Article 6, Article 7, that was where everybody agreed to. But with the double taxation avoidance article, two groups could never be reconciled. And in the end, the OECD said, well, as it is not possible for us to find a solution which satisfies everybody, we don't find a unanimous consent. But then they said, well, we don't need to, because we are only writing the draft and the states do the negotiations. So if there are two exemption states or two credit states, well, these states can then decide on their own what they are going to do. So what they found as, let's say, their way out of the problem was they just proposed two different variants for the Article 23, the A and the B variant. And they just said the states interested in writing a double taxation treaty should then select the variant which suits their particular policy. So the A variant is the exemption country variant. It demands the application of the exemption method everywhere where it makes sense and proposes or excludes dividends and interest income. There also the exemption country fans are in favor of the credit method. Whereas the second variant, the B variant, was proposed for the credit method countries. The B variant says credit method is applied everywhere, at all times, under all circumstances. It does not even mention the existence of the exemption method. So now the states involved can just choose which of the two variants they can implant into their particular treaty. So the states have to choose if they want to take the A variant for the treaty or the B variant. And that means they have to opt for using the A variant or the B variant. And the question is naturally now, what can we expect between which countries? So the first orientation, which you can rely on pretty sure, pretty good, pretty well, that is that Anglo-Saxon countries prefer the credit method, so the B variant. You can even memorize it easily. 23B stands for British cultural influence. So 23B is British. The exemption method, however, is on the other hand preferred by continental Europe. So you could say B is for British and A is for all the others. Or you could even make a kind of memory help. You could make it up from history. The exemption method was preferred by Napoleon and where he had influence. Napoleon is a former emperor of France. So Napoleon is an ex-emperor of France. And it cannot surprise us that the ex-emperor preferred the exemption method. Whereas his opponents, the British, never would have given in to an idea of Napoleon. They fought him everywhere and wherever they could. And how did they finance the war against Napoleon? Probably on credit. So you can memorize which solution you can expect, probably from which country. By the way, that the British fought Napoleon on credit, that's historically not fully true. They also invented the income tax in that context. But the thing is, we just wanted to have help for our memories, that we could find an idea where we could expect the exemption method and where the credit method. So B is for British and A is for all others. Okay, or if you like French, A is for Allemagne and others. Okay, so according to this first orientation, we could prognose prognosticize which variant which country chooses. For example, Germany, France, USA, United Kingdom, UK, Australia, France and Spain, Germany and the Netherlands, all that we could guess. Now, Germany, France are continental Europe, so we expect the exemption method. USA, United Kingdom are both British influenced, Anglo-Saxon countries, so credit method. UK, Australia. Australia is also British. That's also the Anglosphere, so credit method. France and Spain is definitively not Anglo-Saxon, but continental Europe. France was Napoleon's home country. Spain was given to Napoleon's brother for a time, so exemption method. Germany, Netherlands, well, the German and the Netherlands both are in continental Europe, so exemption method. So that works pretty well, and I'm pretty sure if you look up into these individual treaties, you will find that that mostly works. So Germany clearly prefers exemption method. Now you have a problem when countries belonging to the different two groups try to make a treaty with each other. What happens then if, for example, Germany and the UK want to conclude a double taxation treaty? Germany says we want to use a what? And UK exemption method. And UK says we want to use credit method. Then the German says no, exemption method. And the British say no, I'll never sign that, I rather go to hell, I only sign the credit article. The German says no, the credit article is the directly coming from hell, it's a devilish product, I'm never going to sign the credit method article. The British says no, the German says no. The problem is, under international law, both must promise the same thing in an international agreement, otherwise the international agreement is unequal and unfair. So they need to sign the same thing, but they are not willing to sign the same thing. How can you now solve that problem? Historically, 300 years ago, that would have been a very simple or the brutal method to solve the problem. You would have started a war, and who lost it would give in. Now we had World War I, World War II, Germany definitively and very effectively lost both of them, but we still refuse to give in and take over the British credit article. So if even a war is not a feasible solution, then what does a diplomat then do? They take refuge to a so-called diplomatic solution. The diplomatic solution means you don't solve the problem, but you hush it up in a way that nobody ever worries about it. That's a diplomatic solution. So the diplomatic solution is you just go and ask them, well, guys, what about the solution that both countries promise to apply that solution, which in their specific tax culture is the best feasible solution which in their culture can ever be imagined? In that case, both have promised indeed the same thing to do. But that the same thing, the best possible solution, is in the British tax culture something different than in the German tax culture, that is quite natural. You are different independent states with independent laws and culture and sovereignty, and so that in the one tax system the best potential solution is different from the other one. That's natural. That even underlines the main idea of international agreement rules, that states are equal and nobody has to take over the solution of somebody else, that they don't have to obey to orders from another state. That underlines your independence. That is the core idea of the whole principle, that you have to promise the same thing. So that's it. So the diplomatic compromise, which in reality deals with the Article 23 problem, is plain and simple to say both countries select their variant of Article 23, which they want to promise, and that is then regarded as the best possible solution in their tax system with regard to the relations to the other state, and that is therefore tolerated. And it seems to be natural that in different cultures the best potential solution is something different. So for Germany, that would be the exemption method, and for the English, that would be the credit method. So in a concrete double taxation treaty, that's exactly how it is always done in practice. The actual Article 23 of a concrete treaty will always have two paragraphs. The first will be, for example, if the taxpayer is a resident of Germany, so that Germany is responsible for taking measures against double taxation. Then Germany promises to avoid double taxation as follows, and then Germany copies the promises laid down in the A variant. And then second paragraph, if, however, the taxpayer is resident in the United Kingdom, so that the UK tax the worldwide income and are responsible for avoidance of double taxation. Then the UK solemnly promises to avoid double taxation as it is customary in the UK culture, as every UK citizen expects it, as every UK citizen can dream of nothing else which could ever be more favorable, and then UK copies the B variant. So that is how the Article 23 works. And you can, for example, draw the conclusion that in all treaties which Germany concludes, the German resident people will always be treated according to the A variant. Because according to that system, your home state decides which variant is incorporated into the treaty with effect to you. So here, if you are resident in Germany, even if it's a treaty with the UK, with India, with Australia, South Africa, so in all probability, it will be the A variant, which is the 100% or 99 or 95 identical draft for your 23 variant. Yeah? So to summarize that again, every transaction has two articles involved always. Can the source state levy a tax? That is discussed or regulated in Articles 6 to 21, depending on what is done. Income from immovable property, from business activity, from dividends, from interest, from license fees, and so on. And then you always have the reaction of the source state, the state of residence. If the source state may levy a tax, then how does the state of residence react? And that is either the A or B variant, depending on where you live, where you are resident. So there will either be the Article 23 in form of the exemption method article or of the credit method article. And Germany and other continental Europe states will prefer the A variant, the exemption method. Now the exemption method has developed or led to some surprises in the course of time, which then had to be counteracted or countered by special clauses. In connection with the exemption method, several surprises showed up in the course of time. So specific clauses to exclude these unpleasant surprises were added to the text of the A variant or were added as additional clauses when concrete DTT articles were written. So among these clauses you have, first of all, a clause which says the proviso safeguarding progression can be applied. That means that although your foreign income is tax-free, you nevertheless have the permission to use or to take it into account for the calculation of the adequate tax rate. So the proviso safeguarding progression, that is explicitly stated in 23A Article 3, does not preclude the can be applied in case of the exemption. This clause is superfluous. It has only a declaratory effect because it states something which without that clause would also be clear. Because as you know, the DTT only states which state can apply its law to a certain situation. But the state in question can then completely independently define if they tax that item and according to which rules they tax it. So if you can completely independently decide according to which rules you tax a piece of your income, then already under the normal rules of logic, a state is entirely free to decide how and depending on what it calculates or fixes the tax rate of the taxpayer. You could say the tax rate depends only on the taxable part of the worldwide income. You could say the tax rate depends on the amount of overweight of the taxpayer, which is complete nonsense, but it would be allowed. You could make the tax rate dependent on the age of the taxpayer. You could say the tax rate depends on the number of white elephants which were seen last Christmas in the taxpayer's garden. Or you could also say the tax rate depends on the amount of the worldwide income of the taxpayer, including the tax-free amounts. So that is absolutely allowed. This clause is nevertheless always added and mentioned in the double taxation treaty text because, well, there has been, I believe, somewhere in the 1950s, a court decision in some state, I don't know which one, perhaps it was Belgium or so, where somebody said, a judge who did not understand the background of the proviso safeguarding progression and evidently did not understand what it was, that judge said, okay, if the proviso leads to a higher tax on the taxable income than it had been if the tax-free income did not exist, then this is a kind of indirect taxation of the tax-free income, and the judge said proviso forbidden. That was a wrong judgment, a wrong court decision. Everyone knows it, but in order to exclude any repetition of that mistake, since then all states add to their DTTs that clarification. Naturally, the exemption method does not preclude the application of the proviso. If that clause were missing, it wouldn't change nothing in the legal situation, but the clause is an additional gives an additional certainty that such a judgment, a misjudgment of that kind, does not happen again. That is something which you always must keep in mind. International treaties, as we already mentioned, take a long time to get written, ratified, and enter into force. And when you once have written a treaty and later a judge decides something which you did not want, the supreme judge in a country, it is nearly impossible to change that again in a short time. So a general thought underlying all international treaties which are thoroughly scripted is that you must foresee every possible misunderstanding and add clauses which exclude such a misunderstanding. And so this proviso clause is that category. They state something which is evident from the system, but they want to avoid any potential mistake due to the fact that decades or nearly centuries ago there has been at least one wrong court decision by a higher court, and so they said if there was once a risk, we should exclude that risk for all the future just by stating what is clear. Well, one never knows what judges can do if they are on the wrong track. Then, originally, we had the exemption method promised always when the other state could levy a tax. So it did not depend on whether the other state really did levy a tax. So if the source state had under the treaty the right to levy a tax, then the state of residence had to exempt that. That led to the consequence, for example, if state A did not tax something but made it tax-free, then it remained tax-free in your state of residence because that was tax-free. That even complied with the sense of the exemption method, because the sense of the exemption method was equal treatment with the locals. And naturally imagine if you have a treaty clause which says if a French person sells private piece of land, private property piece of land in Germany after 20 years, only Germany can tax it and France exempts. Well, then Germany does not levy a tax and France nevertheless exempts. That would be a very correct result. The French taxpayer would, for his investment, pay zero. But a German in the same situation would also pay zero, so it would be equal treatment. So originally, the exemption method even excluded a virtual double taxation, so a double taxation which could have happened, irrespective of if it really happened. Now, you can imagine when states began to compete for foreign investments, the one or other states came to nice ideas like, well, everyone in our country pays 40%, and for foreigners, we make a special offer. During the first 10 years of your investment, you pay no taxes at all. This was a bit unfair in the favor of the foreign investors, and so the states of residence began to implant or to restrict the exemption method to cases where taxation in the source state was not only allowed but really took place. So you can see such a clause cleverly hidden in expressions like, if the source state in accordance with this treaty levies a tax and not has the right to levy a tax, levies a tax, then state of residence exempts. By the way, that was rather a nice and harmless weapon, because if you really want to run such a special offer for foreigners model, you would then modify your legislation a bit. All my people pay 40%. If foreigners from Germany invest in my country, they don't get 10 tax-free years. They get the first 10 years with a tax rate of 0.1%. In that case, you would have taxed them. And so this clause, the so-called subject to tax clause, would end up with no effect. Later, people learned from that the subject to tax clause is not always a good solution for the potential problems of the exemption method, and so some treaties promised the exemption method, but the state of residence then added a clause which says, I reserve the right to change the method for the avoidance of double taxation unilaterally. That means alone. Just if I send a notification letter to the other state, I make hereby use of my right to end the exemption and exchange it for credit method with effect from the next 1st of January, then that counts. This is a so-called switch-over clause. And the switch-over clause is meant to counter-attack such tricks which I mentioned to escape a subject to tax clause. For example, what happens now in case that a foreign state makes such a superb offer to my people? All my local investors pay 40%, but investors from Germany can get away with 0.1%. This would probably be regarded by Germany as an unfair trick to shift investment from Germany to the other state, and probably you would say that was not the original idea and sense of the exemption method. We wanted to achieve equality and competition with the local competitors. Now, this is far better than the local competitors, so let's make use of the switch-over clause. Write them a letter, exemption is gone, we change to credit method, and then the foreign tax saving model, this special offer, loses every attractivity, because then, with the credit method, you always end up on the higher tax level of the both countries involved. So they would end up with the German tax level, which is probably worse than the local regular tax level, and that would be a nice effect. So back to the subject to tax clause. If a double taxation treaty says that foreign income which is taxed in accordance with the rules laid down in this treaty is to be exempted, that would already be a subject to tax clause. The traditional clause, which excludes also the virtual double taxation, would be formulated as income or property which may be taxed in accordance with the rules in this treaty in the source state have to be exempted. So the subject to tax clause is usually cleverly hidden in the exact expression, the exact choice of words in the exemption article. Here one word changed, which is taxed, changes the meaning and implants a subject to tax clause. Consequences of a subject to tax clause are not always clear to everybody. For example, if a foreign private person owns a house in Germany, sells it after 20 years, and the DTT in question grants him the exemption method under a subject to tax clause. In that case, if the gain from the sale remains tax-free in Germany, the exemption method fails and the credit method takes place, with the consequence that at home you have to pay the full tax. So if an investor from a foreign country really invests in Germany, if they sell within the 10 years period, they get away with the German tax level. If they sell after 11 years, they become taxable at home again. That might be regarded before the background or against the background of the German situation as a bit unfair or not adequate, because there you violate the equal chances and competition for foreign investors. So one might try to restrict the subject to tax clause to such situations where the outcome does not fit into the system. Indeed, there are situations where the exemption would happen in a way that the outcome is in the end not fitting into the system and violates the idea of neutrality for competition. So the OECD only added a subject to tax clause to the article, to the A variant at the end for constellations where complete nonsense comes out in the application of the exemption method. For example, there might be situations where the double taxation treaty is interpreted in a way that the resident state thinks the source state may tax and so we exempt, and that the source state thinks we have no right to tax, so we don't tax. Especially for these qualification conflicts, the OECD has designed an own subject to tax clause. But this is not the only clause. Very often you have in the beginning that rule, if the other state, the source state, taxes, then we exempt, which means automatically if the other state does not tax, then it's not tax-free at home. Furthermore, a subject to tax clause also has some surprising effects. For example, if you have a worker who does work in Faroese for 8 months, where the tax level is 10% only. If under the double taxation treaty, the wages for this time can be taxed in Faroese, these salaries should be exempt in his home state, let's say in Germany. Now, if the double taxation avoidance rule of the treaty says, wherever in accordance with this treaty the other state levies a tax on income, the state of residence shall exempt it. So if we have a subject to tax clause, then the surprising result is if our worker commits tax fraud in Faroese and does not pay his taxes there, then as a consequence of that, Faroestan did not levy a tax in the individual case. And so the exemption clause is not triggered, with the consequence that Germany still has a tax claim for the salary from these 8 months. And so you also committed tax fraud in Germany, or you have to pay the full German tax, let's say going up to 45%. So committing tax fraud for income from abroad, if there is a DTT with a subject to tax clause, is an idiotic idea if the foreign tax level is lower. First, you don't pay 10%, but it triggers a tax claim of 40 or 45% at home. Second, the state of residence will be still motivated in uncovering tax fraud by you. You can be prosecuted here for committing tax fraud with regard to a fairly higher amount. And in the end, it might even be that they, in addition to that, communicate the information to the other states so that you are prosecuted there too. It would even mean if your salary, your tax fraud committed with regard to your salary in the source state has already passed all the assessment period deadlines, so that the tax there can no longer be collected, that then the Germans are happy and say, okay, here you committed tax fraud too, so now we can demand the tax still. For example, if the other state says after 6 years or so tax fraud will be forgotten, then the German says, but you committed tax fraud here in Germany too, because you didn't declare that salary here. It's not exempt here. It can never be exempted because the source state can, by its own law, never collect this tax again. So we collect the tax now and we prosecute you now for tax fraud. So interesting effects of a subject to tax clause which are possible. Now, to illustrate this, again, an example: taxpayer E from Essen works on a job abroad and earns 80,000 there. Foreign country has a tax rate of 20%. His personal German tax rate is 35%. In the DTT, the foreign income is declared to be exempted if a tax was levied in the source state. And now, if you don't pay the tax in the source state, it's not a wise approach, because then the German tax claim is not abolished. It remains in force. And so you can also be prosecuted in Germany for having committed tax fraud with regard to 35% of 80,000. Now, what's a switchover clause? Let's go back to that. State A promises to apply the exemption method, but reserves the right to change unilaterally, but that means without the need of any consent from the other side, reserves the right to change the method to the credit method, just by a written notification sent to the embassy or sent to the fiscal ministry of the other state. Usually that switchover clause is formulated in the way that you can decide if you make use of it for specific situations only, or in general for all situations covered under the treaty. Now, you see, it was meant for situations where the other state creates unfair tax advantages for foreign investors to attract people from your country in an artificial way to invest there, by giving them a kind of a special offer which locals cannot use. You remember that the underlying motive for the exemption method was, if everyone in the local area there where the investment is made pays 40%, my taxpayers should also have a chance to 40%, to the local tax rate, and should not be lifted up to my home state level of 50%. That was the idea. Now you would violate that idea if a foreign state says, okay, the Germans pay at home 50%. You know that's a fictitious rate, by the way. My people pay 40%, but now I make a special legislation that people from Germany who invest in my country are charged only with 5% tax. So that would be a kind of special order or offer which is so attractive that it brings my investors to change over, to shift their investments to the foreign state because it's so attractive. It's even better under competition aspects than the conditions which the locals can ever use. So to such a kind of special offer, you would probably react as a state by trying to make this special offer senseless, and you would make use of the switchover clause. Write them a letter and say, well, that's it. We make use of the switchover clause. Now we change, at least for all income from that specific tax regime in your country, we change to the credit method. Then the 5% are gone, and our investors don't end up with your local rate of 40%, but they end up on our tax level of 50%. So it backfires then strongly to make such an offer to investors from a switchover clause country. This is then a very, very strong incentive for the source country not to create so super attractive investment possibilities for our resident people, because you can foresee that if you deviate from your own tax regime in favor of foreign investors from our country in order to distort the competition, then we will make use of the switchover clause. So a wise fiscal minister of the other country will always say, okay, we can compete for foreign investors if we offer them the same conditions as our people have. If we become too attractive, so if we make life for foreign investors more attractive for our own people, then we must expect that the exemption method will be abolished for these investments, and that will backfire because then the investment conditions will be even worse. So the major effect of the switchover clause will be that its mere existence probably hinders its use. It's kind of a nuclear bomb. The mere fact that you own it usually makes it unnecessary to throw it. The other side knows what will happen if they do nasty things, and so they will refrain from that. Germany has, in modern double taxation treaties, nearly always a switchover clause, but I have not yet seen any notification published that Germany ever made use of a switchover clause in relation to another double taxation treaty state. So evidently that preventive effect of a switchover clause seems to work very well in practice. However, switchover clauses are usually formulated in a way that you do not need to give any reason or even justification for using it. It's completely a unilateral choice. So you could even decide as an exemption state, if you wanted to change your policy, you could even decide to say, okay, we make use of the switchover clauses in all treaties which we have for the beginning of next year, and then the exemption method would be completely gone. The next thing which we also have to know is when it comes to a certain category of clauses combined with the exemption method. These are so-called activity clauses. More and more often, some exemption method rules are linked to so-called activity clauses. That means we restrict the exemption to certain activities. For example, if you have in Faroestan a permanent establishment, and if the double taxation treaty with Faroestan says that a profit of a permanent establishment in Faroestan can be taxed in Faroestan and Germany will exempt, then it would be possible that you set up a kind of a newspaper shop, a small little kiosk, in Far-Eastern and your profit from selling newspapers there is 10,000 euro. That would be a permanent establishment of yours. That little shop would be a permanent establishment of yours in Far-Eastern. Now, you might, in addition to that, contribute to that shop treasury bonds, which bring an additional interest income to that permanent establishment of 990,000. Now that interest income would be a part of the income of the permanent establishment. So Far-Eastern can, under the treaty, tax it, and you would have to exempt it. Now that was not your original idea when you talked about shops and permanent establishments. You thought about factories, you thought about shops, you thought about something else. Now factories and shops, yes, there is a shop, but the main profit here does not come from the activities of the shop. That's rather a trick. You shifted your treasury bonds into the shop. Now they are business property, and the interest income is a part of the business income. But that was not what you meant to do. You wanted to apply the exemption method to the business profits, not to these things which were arbitrarily added to it. So if you have ever come across that trick, that somebody shifted interest income into a foreign PE and then it got tax-free at home, then you probably get a bit wiser and in the future state in a double taxation treaty. The exemption method for business profits is only reserved for cases where the profits genuinely come from business activities, so from selling goods or producing goods and not from capital investments. These things are called activity clauses. And such clauses will either be expressed by the careful choice of the wording in the Article 7 business profits or other exemption articles, or more often one has changed to clarifications in a protocol at the end of the treaty. And such a protocol, if published and signed together with the treaty or signed and published later by the two contracting states, is under international law a full and integral part of the treaty text. So if such a protocol states the contracting parties have consent or confirm that they are both of the opinion that the exemption method for business profits only applies to the profits which come from active business from the following sectors: selling goods, manufacturing goods, rendering services, perhaps then even with a list without rendering services in the following sector, which are suspicious for tax saving models. Or you can write everything down there where the two parties agree that the exemption method is restricted to certain situations only, or that certain situations are excluded from the exemption method. That's possible. So these activity clauses in a double taxation treaty protocol are of high importance. So, by the way, that's now a general recommendation at the end. When you read the text of a concrete double taxation treaty, you always have to check if in that, or in addition to that treaty text, there is also a protocol to that treaty, because that protocol is an integral part of the text, and it might even be that a statement in a protocol revokes something which is laid down as general rule in the treaty in 90% of the cases. One of the most famous protocol rules which I ever came across was that in the treaty of, oh my God, what was it? The European Single Act of 1985. That stated in the treaty the parties solemnly promise, or the parties oblige themselves to definitively create a single European market until the 31st of December 1992. And then there was a protocol statement somewhere at the end which said the parties clarify that the date of 31st of December 1992 has no legal effect whatsoever. So it was a kind of a complete revocation of what was written in the original text. So you will not find such extreme examples in protocols to double taxation treaties, but a protocol is always an important part of the DTT, and so you will, when it comes to Article 23, avoidance of double taxation, always have to read the protocol if it says something on Article 23, or when it later comes to the source articles or state articles, that you also check if there are clarifications on what is meant in the protocol. Okay, that shall be enough for that chapter. Thanks for watching. Hope you liked the video. If you did it, press the like button. If you did not like it, press the like button nevertheless. Recommend the video to people whom you like or to people whom you don't like, depending on the situation. And come back to the channel soon. Thanks and goodbye.